Wilfred Frost joins us now with more. Wilfred, I have no idea where you are, but good morning.
Good morning to you, Joe. I'm at home like many of the team at the moment. So banks, as you said, Joe, got slammed yesterday. The banks index closing down 16%. It's now down 45% year to date, much worse than the S&P 500 26% decline. The latest move lower yesterday came as rates fell following the Fed's rate cut, and as the banks took the extraordinary step of collectively suspending buybacks. More collective action last night as well. They announced via the Financial Services Forum again that the 8 biggest banks are all tapping the discount window. The Financial Services Forum said that their members have, quote, substantial liquidity and wanted to set a lead and encourage its use by other smaller financial institutions. In the past, there's been a stigma about using the discount window for 2 reasons. Firstly, banks didn't want it to be spun as if they had received a bailout, but spun is the operative word there. This is short-term liquidity, not a long-term gift. And 2, more importantly, would tapping the discount window suggest there was an immediate need to do so by some or all of the members? Now, some investors will certainly be worrying about that, especially following the day before's buyback announcement. However, the opposing view is this. Number one, the fact that the Fed directly pushed the banks to do this. Number two, I know it was a necessary condition for at least 2 of the banks to have the Fed push them to do this. Number 3, even before the current turmoil, the stigma of doing so was coming down. Jamie Dimon, for example, at his bank's Investor Day recently, before the most pronounced spike in volatility, said, quote, "We think it's time. We think it's a good idea that will help remove the stigma." And finally, the terms of doing so were significantly improved for the banks by the Fed's action on Sunday night, such that it could be argued it would be imprudent not to do so given the market turmoil. But banks, Joe, as you said at the top, expected to bounce a little today, but nothing compared to yesterday's losses.
Hey, Wilf, real quick, I reported last night for the Times that Morgan Stanley was the first to do it. They did it yesterday. My understanding was that there was an expectation that the other banks were going to do it with them at that time. They're now, of course, all doing it today. People close to the situation suggesting over and over again that, again, it goes really to the stigma issue, that Morgan Stanley wasn't doing this because they needed to, more because maybe perhaps there was a miscommunication. Do you know anything about sort of the state of play?
Well, and that final thing you said, Andrew, is the key point. And, of course, this is your reporting, so you know the ins and outs of it more. But the bottom line is, did a bank, any one of the herd, if you will, really desperately need to do this or not? And your article suggests the answer is not, but there might be some intricacies of when the 8 members of the group ended up formally taking the money over the last 24-hour period. Provided none of them formally really desperately needed it, then I don't think there's a particularly big issue. I will just say, though, briefly, last time around, 2008, the real stresses in the system were in the loan market. So it was in the typical retail banks. This time, over the last week or two, the dislocations we've seen in the market, whether that's trading in treasuries or trading in commercial paper in particular over the last couple of days, clearly has been on the trading side. So it is the brokers that are feeling the heat in the short term a little bit more, and the likes of Morgan Stanley have a higher exposure within their total revenue to that part of the business than some of the others. But the terms that the banks receive by getting this liquidity are very, very attractive, and the Fed has done literally everything to make sure liquidity is there. So I don't think there's any immediate pressures on the banks. The next question, as we discussed with Steve Leisman yesterday, is whether the Fed, if the tightness in the commercial paper market persists a bit longer, whether they start to address that too.
Okay. Wilf, thank you.
Can I just ask real quickly?
Go ahead.
Actually, real quickly from Wilf, you said that there were 2 banks that didn't want to do it. That's so reminiscent of TARP, when I think it was Dick Kovacevic, who was at Wells Fargo at the time, didn't want to do it. Do you know which banks didn't want to? Yes,
I spoke to their CFOs, but I'm not going to reveal which ones it was because it was on background. But again, it's just highlighting that picture of the lesser of the 2 concerns of tapping it, which is this political spin, the potential media spin that they've received a bailout, definitely was a consideration this time round for a couple of the banks. But as I said, the Fed actually issued a statement last night. That hasn't had much coverage. It was a very short statement, but it did say, quote, that we encourage depository institutions to use the discount window to meet demands for credit. And I think, given the market environment, given that this would be done as a group and that the Fed was clearly leading them in that direction, I think all of the banks came together, whatever their concerns. That kind of also addresses the buyback suspension point yesterday. The bank, according to my reporting, the Fed did not tell them to do that, but it was definitely inquiring to them about what their plans might be in that regard.